Welcome to first live streaming of Gray Report episode. Joined by Dr. Matt Bosnagel, Director of Communications and Marketing at Gray Capital. How you doing, Matt?
Pretty good.
So we're doing a live because the Fed is going to come out, a little presser, and tell us about what they're doing with interest rates.
I like to think that they spend like a month before the presser comes out. They're just carefully constructing the words that they're going to say.
Well, do they know? I mean,
nothing out of place. No, they know a month. They've known for years what they're going to do. They're like prophets.
I mean, that would be nice. They're not as data dependent as they claim.
Yeah.
So the news of the week, though, is we had a CPI print that came out yesterday, Matt.
Yes.
That was a little bit of a surprise because it came in, well, I guess it depends on what headline you read.
Mm-hmm.
You can either hear the inflation is still incredibly strong. It's up 4% year over year.
Yeah.
But also you can read the headline that inflation is growing at its slowest pace since March 2021. Yeah. Because the month-over-month growth was only 0.1%.
Yeah.
So that's 1.2% annualized.
Yeah.
But going back a whole year, we're at 4%. What?
Yeah.
Read between the lines, man. What's say
4% still is elevated. If you're talking about like a real number, it's still above the target. Yeah.
2x the target. Yeah.
But I think that if you look back at the history of where inflation has been, last month it was up 0.4% in a single month. I was getting scared. And then we had the huge jobs numbers. I was getting more scared. But now, only 0.1, which is really low. If we had a full year of 0.1s, we'd have like, 1.5 or something inflation in general. So
for the summer.
Yeah. So, and the other thing, too, is year-over-year inflation last month was 4.9, and now it's 4.
Yeah.
So that's a huge drop in just 1 month.
Yeah.
I think that it is great news. I think last month, if anything, there was more optimistic things because it like nominally got year over year nominally got lower, but month over month, like I think that was like a false hope of last month. But this month, there's not much bad that I can see in it.
Yeah.
The only bad thing that I think, and you told me a couple days or whenever we learned about it, energy prices. Energy prices were down significantly this month, and I'm wondering if they're going to come back up because Middle East is going to cut oil production, or what kind of impact that might have.
Yeah. I mean, one of the other headlines, and I'm glad you brought it up, Matt, is core inflation. When you strip out the more volatile, as they say, food and energy, was up quite a bit more if you strip out food and energy, the CPI was up higher because food and energy have actually come down significantly.
Yeah,
And I think we were talking about this yesterday, and you were a little surprised because you were like, "Oh, I thought energy was going to start creeping up because the Saudis are reducing, their drilling or what they're producing." And I think, I was reading articles yesterday that maybe natural gas might start, another bull market. So I think I don't think the story's fully written, but right now today, food and energy prices have decreased, substantially, and that's keeping the overall basket relatively, coming down. But are all those other pieces of inflation now? If you look at kind of the non-core, you're actually just looking at if you're looking, is everything else staying sticky and staying?
Yeah.
That's the question. Shelter being one of those. Which I know we'll get into and talk about a lot.
Yeah. I think that at least for the CPI, when we're talking about core and not core, the shelter is it's an even bigger, slightly, but a bigger component of core because you're stripping out food and energy.
Yeah.
And if you just back of the napkin math, shelter is about 8% of the total for core or for inflation period for all items.
It's 30%.
Or I think that's shelter. So
all shelter. All shelter.
But for rent of primary shelter, which is this discrete category that's kind of the apartment market, is that is about 8% of the total, maybe more or less 10% of the core. So if you're going to move 5%, which I think is totally doable, then you can so it's about 7.5%, I'm sorry, of total. That's the weight that we see right there in the middle. Under, so that's 34, which rent of shelter I think also includes owner's equivalent of shelter.
Yeah,
but rent of primary residence is 7.5 weighted is as part of the total, and maybe roughly, I would say it's 10% or so. Basically, though, if we go from 8.7, which is their measure of rent growth, if we go from 8.7 to a more normal 3.5, then that's like a half a percentage point off of the inflation numbers right there.
Mm-hmm.
And that's almost expected right now. I think that we are at, I think rents, the way that CPI has measured them is, are starting to come down.
Yeah.
And that's, I think, the kind of broader story when it comes to,
and that's what we've been talking about all week, Matt. And, we've been talking about this theme of these, long variable lags and how they can be very confusing and all these base effects that come to place, because the way that CPI is calculating rent, the way that they're looking at it is more reflective of leases that were signed last year. And so we're really capturing more of market rents 12 months ago.
Yeah.
It's not exactly like, it's not like the price was 12 months ago, but that's closer to what it's measuring rather than like the market rate in rents today.
Yeah.
Because we can see that, we know looking back, rents were growing very strong really until about like August or September. Then August, they started declining. And so, we would imagine we would see, that's when we would start seeing the slowdown in CPI around this year in August and September. And so it's not surprising that we still see relatively elevated levels. And also, since rents were still rising, we have that base effect. Mm-hmm. And we also know at the end of last year, kind of Q4 and then halfway through Q1 of 23, we saw rents decline. Demand was at its lowest level, in more than a decade. So there's going to be a period. We can see this happening, that, this fall and this winter, we should see very slow growth. It's going to seep into CPI. And so again, there's going to be articles about how like rents are declining.
Then you'll know that rents are going to start to grow.
And they probably are. I mean, now today, we have this Wall Street Journal article, Matt, which, we can really get into. I've seen it circulate.
Yeah, we'll split it up into two, I guess.
Quite a bit.
The Fed starts talking about something.
Yeah, well, the Fed starts talking, but I think just before.
Yeah.
The title of the headline of this piece is "Renters are about to get the upper hand." Like they're just getting ready to. Mm-hmm. But in the reality, they've already had it. Renters had the upper hand last fall and this winter, and no longer, because rents are increasing substantially. And so I think this is a little bit of a clickbaity headline, but it's been widely read. It's been sent to me by a handful of people, but I think they just missed the analysis. And I keep finding that folks, journalists that cover a lot of different areas of the financial services or news, and then they throw housing into it, or maybe housing isn't their beat, that they can get some of the nuance wrong. And it's a good article, and they do some of the work that, Matt, that you've been doing actually, is that they're taking some of these new lease asking rent prices, and they're putting them all together and comparing and kind of looking at an average. Yeah. Which is really good work, but their analysis really just is they're in their conclusions is a little bit off. It's like their U.S. rental market is slowing down after an unprecedented run. Again, this article would have been appropriate in February. Yeah. But now, if you go look at CoStar, and I don't have the numbers pulled up right in front of me, Matt. But I could get them.
It would be appropriate in February. It'd also be it would be appropriate last September. Yeah. If they really wanted to catch the trend.
Exactly.
What I think is interesting about the Wall Street Journal is I think that they do open up a little bit to the idea that they're going for more mainstream market or a mainstream appeal. And if you look at the CPI, which is CPI measures renewals and market rents. Yeah. So that's what kind of makes it a lagging indicator. But I think, as CPI measured rents go down, then renters in general are going to feel better, but they're not going to get the upper hand, because when you're talking about upper hand, you're talking about the market negotiations of new lease rents. So it really is an inaccurate headline.
I know. So
no, that's fine.
If you saw that presentation, you're like, I'm interested in those slides. go watch our last YouTube live. We did it last week on Tuesday. We did a whole live on upcoming loan maturities in the multifamily market. Just Matt, let's check on the presser. Chair Powell to speak any moment, and I saw something across the Chiron saying maybe the Fed could even increase rates. I don't know. I think because the consensus right now, not to go back and forth, but the consensus right now is that there will be a pause.
Oh,
there'll be a skip.
I heard there's a 7% chance of a 25 basis points increase. That's the one that I glommed.
A 7% chance?
Yeah, 7% 25 odds. Like betting odds.
Yeah, because I was interviewed. Matt, last week by Multi-Housing News. It's, will the Fed finally pause interest rate hikes? And then they asked me for my opinion, which I was humbled to provide. But I'm like, I don't have a crystal ball. There's so many moving pieces, and what should happen, and what I think is going to happen, aren't necessarily the same thing.
Yeah.
And I was a dissenter saying that I think, there's a good chance it'll plateau, but I'm not ruling out a 25 basis point increase, for the idea being that the Fed and Jay Powell need to restore confidence at the Fed.
Yeah.
Because, transitory inflation, the whole idea that it's transitory, got away from them, and they kept rates at zero for far too long, and it got them in a lot of trouble. And so they need to say, hey, no, we're serious about this. Again, you can trust us. We've got this under control. And that they with seeing economic growth, unemployment rate so low, can they get away with another 25 basis point increase to really just nail that coffin down?
Yeah.
The whole coffin to say, let's put this thing to bed.
Because
and right here we got Jay Powell coming.
Oh, here we go.
The answers. Let's head it over to Fed Chair Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Just went from 7 to 14.
The outlier here.
Early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
All right.
Continue to
Looking
reduce
ahead,
securities holdings.
nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
Still be scared.
And I'll have more to say about monetary policy after briefly reviewing economic developments.
Let's maybe talk about that for a little bit, Matt.
Yeah.
And we'll probably fade off from the press conference just for now, as we'll go back and listen to some of these reporters' questions kind of at a later date. But Matt, let's talk about multifamily. Let's talk about the effects of the fact that the Fed funds rate is being plateaued in a range of 5% to 5.25%. That is great news for borrowers that have floating rate mortgages. They're going to avoid paying another 25 basis points more a month. But the question that I have for you, Matt, is how consequential is this? What would have been the difference if they raised interest rates 25 basis points? Does it matter? Have we already passed the point of no return, or does this signal an inflection point in a change of something different?
I don't think it. I think that they had their target in mind. I mean, just as much as I joked that they had it 2 years ago, but they did have their target a long time ago. They've kind of been telegraphing
last year's Fed dot plot and see.
Yeah. But as we say kind of every month, they don't take too rash decisions, although I think that there is an emotional valence to an increase rather than a pause. I think when woman was asking her question. She wanted to know if I almost think that she was saying, okay, you're pausing. Shouldn't you raise? Because are people going to get too excited about pause? At least that's what I'm thinking.
Yeah.
And that was a lot of in Powell's, when he was reading stuff, when he was reading those strong jobs numbers, it was like, okay, jobs are okay. Like just the way that he's delivering this information is kind of funny.
I mean, we were pulling up the S&P 500. Today, it dropped right before, but it's gone up since. But I mean, Matt, the S&P 500 has been doing really well, and after having a horrible end of the year last year and beginning of this year. So I mean, it's a decent question to say. You're saying that we need to slow the tightening down, keep it where it's at. But man, things are running so hot right now.
I know. That's what,
is there a sign that there's just too much growth in the system? We need to continue to address that with rate hikes.
I mean, if it's hard for me to not think that, because there was a lot of the figures that he gave. He's talking about lower GDP growth expected. He's talking about higher unemployment expected. And he said, and this I think is a key quote, it will take time for the effects of although it's been nearly a year.
It's been over a year since they've started.
Yeah.
But it hasn't been a year since things have gotten really high and tight. Now, those first increases were big. Those were big increases. But yeah, it's going to take a while for it all to see.
And by saying it will take time also carries an important and powerful implication that it is going to stay high. Because if it's not, you wouldn't say that. It's like, it'll take time for these effects to be felt, but don't worry about that because it's going to zero by August. Like, that's not going to happen. I think that he was trying, a lot of it was trying to bolster the feelings of people like you and me who are saying, well, maybe things are running too hot. Because he talked about how when they increased it, look at how fast they increased it.
Yeah.
And I think that was the spin, at least the kind of emphasis and tone that he was trying to say is it seemed like an acknowledgement that things are running still hotter than you'd think, given
they're running hot. But just think back to what we were just talking about before the press conference started. They know what's going to happen over the next couple of months.
Yeah.
They know against some of these, the variable lags like housing is going to start seeping into CPI in the next couple of months.
Yeah.
And so they're saying like, look, we're comfortable with the way things are right now. I got another, I'm loaded though. I got another bullet in the chamber. We got it.
Yeah.
We'll use it if you make us use it. And so he has to signal the market. He has to say we're ready to continue to do more. It can't pivot. There was whole talk about the Fed pivot. It's not a pivot. It's we're pausing and we're ready to keep going. Or again, that's at least what he has to message.
Yeah.
But I believe in their mind, they're done.
Oh, you think so?
In their mind, I think that there is a possibility that, I mean, sure, things can change, but I do think that they believe, and it certainly could be correct, that they have achieved the soft landing that they were hoping for.
Yeah. I was just thinking about that when the CPI numbers came yesterday. I was like, this is it? I mean, employment's high, CPI's low, but now I got to feel nervous a little bit because there's something mismatched about that. And that's what I want to wait for this to kind of like resolve itself. But there is a lot to be said about the duality of high jobs and low prices.
Well, I think he mentioned the duality at the beginning by addressing the fact that things are still strong, but we have these long variable lags, and things are coming down. And so we have to acknowledge that, and we have to acknowledge that in the future, we know some things are going to come just down in the numbers, but there's still a risk out here because of unemployment, and we're aware of that.
Yeah.
But in the only way to thread the needle, this needle of the economy that we're dealing with post-COVID, post-pandemic, it's going to look confusing, and it's going to look double-sided, and it's not going to be clear-cut. So whatever the solution you think could have been, it was always going to be this messy.
Yeah.
And I think it's so funny, or it's interesting how certain so many sources can be and experts.
Yeah.
When we're hearing, we've heard that soft landing is an impossibility sometimes. We've heard that it's certainty. We've heard that a recession is, I mean, when I start seeing 100%, I'm like, what do you mean 100%? Nothing. What is
Wall Street Journal?
What is 100%?
Yeah.
Like, what can you really truly say is I'm forecasting an event into the future? Because nothing is certain. I mean, nothing is certain.
Yeah.
You know, you can be 99.999. There can be a lot of nines, but it's never 100.
It is interesting to see that. I mean, their March projections were that the economy would be doing a little worse, I think, or at least they were. And I think that was maybe in the midst of a lot of the banking crisis, crises, but also like in general, there was maybe slightly less confidence. I feel like we are at this weird, we're not scraping by surviving. We might not necessarily be growing at the clip that we were growing like last year, but like the more that we're in this state of like, are we gonna do bad? Like, it's like, if we spend a year doing that, what is that year?
Yeah.
That year's a decent year.
It's the fog of war, and it's where I think we're going to start seeing opportunities as the dust begins to settle, but there's still dust in the air, is where you're going to have to start striking while others are still on the sidelines. Because, we know it's hard to, find opportunities and make opportunities work. And there will be some people that's easy to fall into this go down this path of just kind of getting defeated, just assuming the market doesn't work right now.
Yeah.
And being like, and then there aren't any deals. There are no deals.
Yeah.
There are deals in every market. It just might take a little bit thinking about it may take thinking about it differently.
Yeah.
It may take looking harder, it may take looking in different places, it may take changing your criteria a little bit without changing your kind of standards of risk.
Yeah.
Maybe it takes examining that as well. But there's always deals, and we're going to be approaching, I certainly hope, and I do believe this, we're getting closer to a period of where the deals will start emerging, but there's going to be, 50% of the market that still is going to be pencils down, believing that there are no deals to be done. Yeah. And so that's where it's going to be an opportunity. I don't know if I don't know. I don't know if it's right now. I think we're getting pretty close though.
And it's so weird. And just to kind of come back to that Wall Street Journal article, some people think that we're headed down, and other people think that we're headed up. You say that you see the same figures, and you're either at the top of the mountain or you're starting to climb up it.
Absolutely, man. I sent you an email right before we got on, and so I know it's like not included in this, but it was a piece from CoStar.
Yeah,
and basically the email was it was describing all of the different potential recession forecasts, and including one of their own. They use Oxford Economics as their macroeconomic data provider, and they have their own forecast. And Oxford Economics, they're projecting a recession in Q4 of 23. There's a lot of predictions for recession in Q4 of 23 or Q1 of 24. Basically, end of this year, beginning of next year. But it's all over the map. There is no consensus. There's just not a consensus.
Yeah.
And now again, I don't know what all the right moves are. But I do know that in that type of environment, there's a lot of opportunity and there's a lot of money to be made.
Yeah. Yeah.
Because when the market's not sure what to think, it's you just have to kind of filter through the noise, which is way easier said than done. But if you can't, so you can find some opportunities that
it almost makes me think like
take some work.
People are looking for the post-financial or the financial crisis for like a antecedent or like for an example, and that happened so quickly. It seemed like things started tumbling down with Lehman Brothers and all, and then you heard about the housing market just crashing. It's like that was so dramatic and discernible, and we had such a source. Now I think source might be office market and commercial real estate potentially, but right now, no one's like, oh, we're building to something. And the people that are saying that are the ones that say it every year. But it's hard to find the sort. There is, consumer credit, like revolving credit, is a little bit high, or is high, but it's not like skyrocketing up. It's just like trending high.
I do think that there is. We'll have to see what happens with all the loans that are coming due at the end of the year and beginning of next year. And then whereas outside of my pay grade is all of the derivative products behind all those loans and all the, the synthetic derivatives that are, you got your property, you got your loan. Okay, well, that's bundled up. And then how is that broken out and further securitized and then, and again, synthesized and then chopped up and moved around and then levered because the idea is that, these multifamily loans, the foreclosure rate is so low. The default rate is so low. It's 0.2%. It's a fraction of a percent. They're even equity investors, have seen, multifamily as one of the safest bets and most risk-adjusted returns. There's risk in everything.
Office used to be seen as a safe bet, though, too.
True. Well, and people were moving away from office, and his office was the darling of, for the longest time, commercial real estate. You think of commercial real estate, you think of office.
Yeah.
And multifamily just seemed like was always this like black sheep. I don't know, just this other sector that was like a little, I don't know, just less clean because it's like you had to deal with the everyday person.
Maybe. Really? Okay. Was it less corporatized because?
Well, less corporatized, much more mom and pop.
Yeah.
So you're dealing with people. You're just dealing with people. You're not dealing with companies. Office and industrial. Folks like that because it's like you're not dealing with it. Evicting somebody. You're not dealing with qualifying them for income. We're not dealing with kids running around. You're not. You're again not dealing with tenants and toilets and all that. Yep. You're dealing with a business and their needs, and it's much more straightforward. It's less services and operations.
Yeah.
But then, but those problems don't always end up meaning to like less returns on the multifamily side. We're making a lot of money doing it. Yep. And it's actually the economics of it are very attractive from like a risk return perspective because of just what the demand is. There's always someone that needs a place to live and be in balance, but typically over time, the housing, there'll always be a degree of house demand. How do you can't have too much?
Yeah. And that's can't necessarily be said anymore about the office market.
Yeah, no, it's not. You don't, exactly. You can't say a business will always need a place to meet and get on their computers.
And there, yes, this floating rate loan issue where the loans are coming due for office and for multifamily. I wonder if there is going to be a little bit of a difference with the office market because their leases are like longer term. It's not like necessarily like every year, like a renter, maybe a business based 5 years. So I wonder if they could kind of still limp along for longer, maybe but still.
Well, if their loans coming due, the loans coming due.
Yeah, but if they're getting that, if they're 5 year, if their loans coming due, but they can't find another tenant, that's a lot bigger problem.
Yeah. Well, they are both. If there's money coming in, maybe the bank will work on an extension or a modification, or I mean, it's not going to be good. I mean, because it's going to be like you took out a $10 million loan because you thought that the property was valued at $13 million. Now the property is actually valued at $5 million.
I mean, thinking about what if
$5 million?
What if demand for office is permanently down 10%, even just 10%?
Yeah,
that's not.
No.
That doesn't bode well, and I don't know.
30%.
I don't know what the number is, but when there was a housing crisis, people were still living in houses, just couldn't pay for it. And there was a big deal. But there's a lot of money tied up in office market that people may not even use.
Yeah. Well, and it's and again, it's this financial crisis. So it's the multifamily and the office side, and who are the investors in those products? It's big institutions, it's insurance companies. It's other it's banks,
like pensions,
the pension funds, insurance companies, banks. Because they're like, okay, they have all these assets where they have to allocate it somewhere other than cash and just 1 month treasuries, and they're looking to get a little bit of yield
for low risk, right?
Yeah, exactly. So they're thinking low risk.
Yeah.
So they're looking out and they're like, well, think of it 2 years ago. Like, okay, well, I can get like nothing even on a 10-year treasury. I'm getting 0.5%, maybe 8%, but maybe I can go out and buy some of this, MBS or these CDOs.
Like these are like the securitized loans for commercial real estate.
Yeah, mortgage-backed securities or collateralized debt obligations. And I can, so it's pooled of mortgages, and I can get 4%. 3%, 4%.
Yeah.
Well, it's a lot more than I'm getting in treasuries. And what's the default rate on these? It's next to zero. And then let's lever on top of that, and maybe lever on top of that, and lever on top of that, and then lever on top of that, and lever on top of that. And again, I don't know, like, I'm not the expert in that area, but I know.
That's a good point, though, because the way that risk has changed, this massive shift of like, well, now office seems a little more risky, but before you could maybe up your leverage if it was more risky. Then it's like, well, things aren't going to go upside down. It's office. Who's going to stop going to work?
Absolutely. And people did the same thing with multifamily too.
Yeah.
Feel like this is a great location. Multifamily is a great asset class. You're a great sponsor. We know you. Rents are growing. Interest rates are low. Interest rates are going to stay low. Rents are going to keep growing at 20%.
Yeah.
We'll give you an 85%, LTV loan, interest only.
Yeah.
And we'll also give you $1 million of, line of credit. And, you're going to be buying at that 3.8 cap.
Yeah.
That's
trouble.
And again, that's not the whole market.
Yeah.
It's a part of the market, but it's definitely a part of the market. And that's where the pocket, there's going to be the pockets that just do the pocket spread.
Yeah.
We know there's a lot of people who took on too much risk, and like they're like the math is too far the other direction. Like the math doesn't make sense. The hole's too big.
I remember you were talking about this. This is outside of the Gray report, but you were saying, if there's all this trouble with the office market defaulting on loans or troubles with financing office properties, do you think that's going to make the banks more liable to lend to multifamily or less liable to lend to multifamily?
Credit
it's going to be less.
Credit is not going to be looser.
Yeah.
There's not going to be more money like floating around to save people who've made mistakes. Like, will there be some? Certainly, and who's connected, and whose friends are friends of someone. But it's all correlated to some degree. I think there's a good chance that multifamily gets by with again pocketed distress, pocketed foreclosures, the market coming down 5 to 10%, the deal's starting to make sense over time, maybe not all at once. Like, there's going to be a few like examples of fire sales that happen, but it's not going to be the market. It's going to be a couple deals over here, a couple deals over there, and then it equalizes probably in the middle. Like you had like right now what's going to happen. But without a doubt, again, so what I think, conclusion, and I've talked about this the last couple of days.
Yeah.
The Fed pausing, the Fed increasing 25 basis points, it's sort of inconsequential. It will help or in effect several folks on the margins, like on the margins. But for most of those who are on the margins, I believe that they can figure things out, and they probably would have made it either way.
Yeah, I agree totally.
So, there is a percentage, and we don't know what the percentage is. So we haven't been able to figure this out, and it's the big question: is who are those that, again, the hole's too deep?
Yep.
It's not they have to bring the 15% of the equity or 20. It's not that they have to bring a couple hundred or $1 million. It's like, the equity raise was 5 and they have to bring another 5. Like they have to bring 100% of what they had raised or more, because they were 85% levered or more, 90% levered somehow. And they had pref equity, maybe they had multiple, equity classes. And there's going to be some investors that lose. There's already been investors that have lost. We detailed in the Apple's Way.
It is interesting when you're talking about that much leverage, how just like a little shift positive, then you're saved. But then if it gets negative and you can't figure it out, then you're hosed.
Absolutely.
And honestly, if you're talking about if people think that they will survive this high interest rates, it's there's just not enough time for it to go back down in time to save everyone. It would take a crisis that would also be bad news for these investors as well to have the Fed go down that much. And I just do not think that that's going to happen at this moment.
Yep, agreed. Well, Matt, this was a great little test run. We had a couple folks join us. Griffin, thank you for
so much more I wanted to talk about too.
I know. Well, we got next week.
I've got I just want to tease this a little bit. Wall Street Journal had tracked 5 different private rent trackers. We track We've been tracking at least 8 or more, and at a level of sophistication that is going to just dazzle you. I'd like to tease that for sure.
Yeah, Matt definitely feels attacked because and I saw this. I was like, Matt's gonna not like this. So we're working on a report that like compares all the different rent trackers, and Matt has been aggregating and tracking this. And Wall Street Journal has attempted to do this. I don't know if they saw yours, Matt. That is probably what is usually the case.
Yeah, we were talking about that. And just one note that I wanted to note that I wanted to include while we were talking. They say that rents are on the way down. But if you look at the month over month rent growth, which is what we've been tracking, month over month has steadily increased and increased and increased. So this downward trend. Yeah, it doesn't look great on that chart, but
I think they're just honestly looking at year over year.
Yeah,
they're
only looking at year over year.
Month over month.
Yeah, I know, but that's what they leave out of their discussion.
Exactly. That they're showing a picture, and then, but this is from CoStar.
Yeah,
this is daily rent per square foot.
Yeah,
So if you look in perspective, like they're showing this piece right here, like they're showing this.
Exactly. Yeah. There it is.
They're showing this decline down to the end of the year. They're not showing this 45-degree angle to the right.
Yeah.
Up and to the right.
Yeah.
So again, you if you want to know, here's the conclusion, and then we're going to leave it on this. Because then we've got an exciting interview that's going to be posted later with Director of Property Management at Gray Residential, Katrina Green. Is if you want to find the best information, not just like information, but you want to find curated.
Here's what to ignore. Here's what to notice.
Cut through the noise. Come to the Gray Report. That's what industry leaders do.
That's right.
That's what owners and operators of tens of thousands of units. We probably have, I'm doing some very quick math here, Matt. Probably have owners that I know of personally.
Yeah.
Probably 75,000 units that I know watch and listen to the Gray Report. Or probably for the field that I'm not 100% sure on, is probably pushing 100,000.
All right. Keep them growing.
At bare minimum. And that's like, and there's a couple of those that are made up of like 20,000 unit chunks, 20,000 unit chunks.
Yeah.
So if you want to get the information from the same place that those folks are, you just keep coming back to the Gray Report. Sign up for the newsletter. Hop on over to graycapitalllc.com/report. And we've been talking a lot about these loan maturities. You saw the YouTube live presentation that we did last week. But if you want to actually get that report so you can review it yourself, just hop on over to graycapitalllc.com/report. It's really easy to do. It just takes a second. Just drop in your email address, your name. I don't even need your last name. We just need your first name. And then anyway, make sure you're not a robot. You're going to get sent this report, and it's going to give you all the information. Again, this is on the live, but I mean, oh my God, it's just data and just straight to the point. And Matt Bosnagel's involved in it. And if you miss this, you're going to just have a gap in your knowledge base, and you're going to be flying blind.
Yep.
So, all right, thanks again for watching this Gray Report Live. We'll be doing these again. I don't know if everyone's going to be live, but we'll be doing them more.
Yeah.
We'll figure it out. And
this went a lot better than I thought. I'd be terrified to go live.
I was a little nervous.